Why do bond prices fall when interest rates rise? And why does the Fed's policy matter so much to fixed income investors? If you've ever struggled to understand bonds, today we're breaking it all down in simple terms. And stick around until the end. We'll share an easy method to quickly assess bond price changes without the confusion.
To wrap up the show, we're moving into investor education. Today we're talking about bond price and the yield inverse relationship. Gary, I'm going to turn it over right to you with this question. How do interest rates affect bond yields and pricing? Thing number 5, break it down for us, Gary, and I'll try to follow along and ask good follow-ups.
All right, stick with me here because this can be confusing for a lot of people. It's a key concept in understanding the fixed income market, just a fancy way of saying bonds. It's the inverse relationship between bond yields and prices. So when bond prices rise, yields fall. When bond prices fall, yields rise. So let's talk about the reason for it. So think about the value of a bond. Rob, if I, sell you a bond, what you would have is a promise from me to pay you periodic interest, maybe every month, every quarter, every year, and a promise to repay you your principal at maturity, at the term that we've decided on. So the value of what you would own in that situation is the sum of the present value of all the interest payments plus the principal you receive at maturity. So if interest rates rise, newly issued bonds would offer higher yields, making older bonds with lower yields less attractive. As a result, the price of bonds with lower yields would drop. So we can go to a concrete example. Let's talk about a 10-year Treasury note with a face value of $1,000 and a 5% coupon rate, and that's the example. So that bond would pay you $50 in interest annually, and 10 years down the road will give you your $1,000 back. So if market rates rise by 50 basis points, 0.5%, new bonds will yield 5.5%. And so instead of $50 of interest, they're paying you $55 of interest. To stay competitive, the older bond would need to drop in value to $962. So it would lose $38, assuming it still has 10 years to maturity. And the reason is because the yield on the old bond needs to match the yield on the new bond, right? The market will arbitrage or take advantage of discrepancies in pricing, right? So, we can give you another example here. Imagine you purchased a 10-year note in January of 2021 when the yield on the 10-year note was about 1%. So new 10-year notes right now have a yield of about 4.25%. So the difference is another 3.25% more in interest, right? 4.25% now, 1% in 2021. So your older bond becomes much less desirable because you're only getting $10 of interest versus, $42, $43 of interest.
Yeah.
And so the only way that the value of your old bond will be able to compete is to lower the price.
Gary, with that being said, it seems like, understanding the Fed interest rate factors. I mean, how critical is that when it comes to investing in bonds and understanding what that means if this is something that you're interested in?
So it does matter. It matters to the extent that most of the yield curve, and I'll explain what we mean by that, gets priced off of the Fed funds rate with exceptions. We'll go through that. So when we talk about the yield curve, we're talking about the rate of interest for the overnight rate. That's the Fed funds rate. And then people will look at the 1 month, the 2 month, the 6 month, 1 year, 2 years, 3 years, 5 years, 7 years, 10 years, 20, 30 years. And so what we look at is the interest rate throughout the yield curve, the interest rate on the short maturity notes and on the long maturity bonds. And so that's the thing that we're looking at there. Now, here's the exception. The exception is that the market will make its own assessment. And we got a great example of that starting last September. Last September, the Fed started to cut interest rates. And ostensibly, the reason they did it was to reduce borrowing costs for people. Well, guess what happened? The Fed cut interest rates over the next few months by 100 basis points or 1%. But the yield on the 10-year note actually went up by 100 basis points or 1%. So what we saw was that the Fed funds rate came down and the yield on the 10-year went up. Why is that? And the reason is because the market was correctly understanding that lower interest rates lead to more inflation. And so the market was discounting the value of the payments on the 10-year for higher inflation in the future. And as a result, took down the price, which raised the yield. And so what the Fed does matter, but sometimes the market will move in the opposite direction. And this is a situation, we just saw it a few months ago, where the Fed lowered rates and the market actually increased the market rate of return on bonds. And that's the reason the yield curve uninverted. For those of you who really like the terminology, what that's referred to is a bear steepener. And what that means is that the yield curve gets more steep, meaning higher at longer durations. But the way you get there is by having lower prices and higher yields on the subsequent issues of the longer bonds. Again, that's more complicated than we intend to go into here. But for those of you who know this stuff and want the language on it, that's called a bear steepener.
Very good stuff, Gary. And thanks for breaking that down for us. If you have any questions or different topics you'd like us to cover in this education portion of the 5 things, again, please leave us a comment. Head to deepknowledgeinvesting.com, use the Ask Gary feature. Would love to continue education of our audience, new, beginner, basic, intermediate investors, as well as advanced as well, with some of these topics that we cover. That concludes this week's version of the 5 things. Gary, always a pleasure being on with you here. We'll be here next week as well, keeping you in tune with everything that's happening in the investment markets and making sure that you're up to date, know everything that needs to be known about the market to make the best decisions possible for you and your portfolio moving forward.